Hello, hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. Huge show for you today. A lot to talk about. If you're watching this on YouTube, take a moment, hit that subscribe button for more content just like it. What are we going to be discussing today? Of course, we have to start with the stock market. We're finally getting that correction that we talked about last week, potentially starting. Well, now we're in the midst of it. We're going to be talking about Mania. We had a big mania in 2021, and this is the other side of it. We'll give a few more examples of that. Netflix reported earnings. Valuation seems to be mattering again for a lot of stocks. Tesla cut some jobs. We'll talk about that. The housing slump is continuing. And we'll end, as we always do, with something positive, the fact that you're going to be earning higher yields on your cash for longer. So let's begin. As Led Zeppelin said in that song, if it keeps on raining, the levee is going to break, and the levee broke this week in the stock market. If we look at the S&P 500 here, you see this incredibly smooth uptrend going on for months, and finally we've broken through that to the downside. First close below the 50-day moving average since last November, ending one of the longest uptrends we've seen in history. It was actually the 10th longest going back to 1950, 162 days without a close below that 50-day moving average. So as we've talked about for weeks, highly, highly unusual for a market to be going up this smoothly, this steadily, without really any pullback to speak of. Well, now we finally have this pullback. So I wanted to take a look at what the market had did previously following the end of these long streaks above it. And as you can see, nothing really in terms of a pattern here to glean. Sometimes a year later, the market is higher. Other times the market is lower. I think the biggest takeaway for investors is we're now in a different environment. So the notion that we're just going to start an incredibly smooth uptrend again, probably not likely. To appreciate what we just went through, which was a pretty low volatility, easy market for the last 5 months, and now we're in a different regime. What comes next, anyone's guess, but this is a return to a more normal market. And in terms of corrections here in the S&P 500, nothing huge at all. This is par for the course. I listed here corrections greater than 5% since the March 2009 low. And as you can see here, we're now about 6% off of the high from the end of March. And what are the reasons people are saying stocks are going lower? Well, the reasons are always different. As you can see here, the reasons vary from one correction to the next. Today, they're saying it's because of inflation, the Fed pushing back their rate cuts, and the Iran-Israel conflict that seems to be escalating this week, and a lot of uncertainty, of course, about the impact of that on the economy, on oil, on inflation as well. So for now, we're looking at a very typical correction, 5.9%, nothing huge, nothing to write home about. The big fear, of course, is that inflation component. If we start to trend back above, let's say 4% in terms of the inflation rate, I don't think that market participants are pricing that in or really viewing that as a possibility today. I think that they're viewing inflation as being stubborn and staying over 3%, but I don't think people are yet talking about the possibility that it could make another run higher above 4%. And what could cause that to happen? I think number one thing would be if we saw another spike in the price of gasoline. So if we saw crude oil, let's say, go back above 100 and start to escalate higher because of shortages, because of this conflict between Israel and Iran, if we start to see that, that could certainly push prices back above 4%. Without that, going to be, I think, more difficult because you have the other components of CPI, things like shelter CPI, likely still to continue to trend lower, so helping push it down. But anything can happen, obviously, over the next few months. So this, I think, will be the big one to watch. Are we going to see higher gasoline prices and, in turn, higher rates of inflation? And in terms of the biggest story stock in the market, you know what it is. I've been talking about it a lot over the past year. That would be NVIDIA, finally breaking here in terms of a little bit of a pullback. Like incredible gains that we saw in NVIDIA in the first quarter, just tremendous, up around 90% at one point. And you just had this sense that it was never going to pull back. Well, that's impossible. Something that's gone up this much always has pullbacks, and now we're seeing NVIDIA down very quickly here, 19% from its peak closing price in March there. And if we look at AMD, this is an example of how quickly things can change for a stock. You had it up over 40% on the year in March here, and now it's actually down on the year. So we talked about semiconductor and how important that sentiment had been to the overall market and how extreme the outperformance from the semiconductor sector had been. And to watch that as a potential sign of a turn for the market, and now we're starting to see it, money finally coming out of these semiconductor shares, a little bit of a return to reality, I would say, for the market. And if we look at the enormous eight here, we have been talking about the two laggards. Well, they're still lagging, Tesla and Apple, down on the year. Tesla being, I think, now the second worst stock in the S&P 500 this year, down 41%. But Apple hitting new year-to-date lows this week as well, down 14%. And very quickly here, we went from a market that had one of its best starts to a year in history, S&P 500 up 10% in that first 3-month period, to now being kind of a normal year. It's up 4%, equal weight up just 2%. Small caps are actually down. If we look at the Russell 2000, actually now down on the year. And a lot of these huge gains for the enormous eight are starting to moderate here. So as we talked about, NVIDIA being up over 90%, now up 56%. So still an enormous gain, of course, but starting to see a little bit of air come out of that sentiment that we had talked about for months. Very extreme sentiment building. We hit a peak in that sentiment in March with a number of indicators, active managers going levered long. We talked about the Investors Intelligence poll hitting a huge extreme between bulls and bears, and a number of things were stretched in this one direction, and now we're starting to see a pullback. So it'll be interesting to see next week what the reaction is in terms of sentiment. What you want to see is the bulls start to switch to becoming neutral or bearish. You want to see the active managers pulling back. You want to see a sentiment reaction that people are actually fearful of this correction, that fearful that it's going to become worse. Number two, the other side of Mania. This has been a huge change in terms of the temperament of the market from a few years ago. And I would say one of the big consequences of removing that zero interest rate policy is the return to sanity, a return to normalcy for the market. We had a number of things in early 2021 just looking absolutely ridiculous. Peloton being one of the most extreme examples. I wrote about it at the time. It hit a market cap of over $49 billion at the time. Just incredible to see. And if you fast forward to today, where is that market cap today? $1.2 billion, down 98% from its high. And of course, what happened here? Well, the market was assigning a huge multiple to Peloton back in early 2021, expecting the astronomical growth rates from the pandemic to continue. They did not continue. Growth slowed. Growth actually turned negative. Multiples compressed. And now you have the other side of Mania, which is what I call the weighing machine, which is what Graham and Dodd talked about, which is that in the long run, the companies are going to trade at their fundamental intrinsic value. And we're seeing that with Peloton. What's another example of this would be Rivian. Rivian went public in late 2021 during the peak of the EV mania and very quickly shot up to a market cap of $153 billion, which was notable because it was more than both Ford and GM combined for a brief moment in time. And Rivian had barely produced any cars. It had obviously negative net income. It had almost no revenue. So it was absolutely insane valuation at the time. And we talked about it a number of times, saying that what essentially these investors, if you call them investors at the time, were saying in buying this at $153 billion market cap, they were saying that every single thing in the future was going to go right for Rivian, that there wasn't going to be any hiccups, that it was going to grow tremendously. It was going to become the next Tesla. And what I wrote about at the time was that it still has to prove itself. Maybe that'll be the case, but there's likely to be hiccups along the way. It has to prove itself, and market participants back then were behaving as if that future, that rosy future had already happened. And when that happens, where you have such a divide between the current reality for a company and what investors are pricing in terms of that reality, then you have the setup for a huge decline. And that's exactly what we've seen, down 95% from its peak down to 8 billion. Of course, still losing money, still losing a massive amount of money. I think last quarter they lost $40,000 for every car they produced. So obviously not sustainable. They have to cut costs and do something different. So we'll be interesting to see in their next quarter if they're already starting to do that. But now the current market cap, much more a reflection, let's say, of reality where it stands today. Back then, total disconnect from reality. And lastly, Virgin Galactic probably being the most speculative of these companies. And what we saw back in 2021, again, early 2021, the peak of the SPAC mania, peak of the boom in meme stocks, early 2021 shot up to enormous levels. And now we're seeing a decline of 98% from the peak. And the interesting thing is, not too much has changed in terms of the fundamentals. It was losing money back then, still losing money today, a little bit more money. It actually lost in 2023, lost 502 million. But the difference is the investor's attitude. So nobody cared about valuations back then. No one cared about profitability back in early 2021. It was only about the story, only about growth. And today, with 0% interest rates gone, with the Fed tightening and staying out of the stimulus game, at least for now, you have a return to reality. 98% decline from its peak. Market cap went from around 15 billion down to 400 or so million. And if it's losing money this quickly, the question quickly becomes, unless it gets a new source of funding, is this company going to be going bankrupt at some point in the near future? So number three, the large cap, small cap divide. And we've talked about this a lot, but want to touch on it again. There was an interesting article from the Wall Street Journal talking about the interest coverage ratios between large and small caps. Really explains, I think, the divergence in performance over the last few years. So, of course, interest rates rising significantly over the last 3 years, and you have the S&P 500 up 28%, small cap Russell 2000 down 9%. And if we look at these interest coverage ratios here, I think it really tells that story. Simply put, the small cap companies are much, much more sensitive to a rise in interest rates. Their operating income, they're using a much bigger portion of that to service the debt than large cap companies. So 2.3 times would be their operating income over the expense that they have to pay in terms of interest, whereas the S&P 500, 7.6 times. And we talked about last year, companies like Microsoft and Apple, they have these enormous cash balances. They've locked in their debt cost long term at very low interest rates. And so they're actually benefiting from, or they have been at least, from this rise in interest rates so far, because they're earning a higher interest rate on their cash balances and their long-term debt is fixed at these low interest rates. So similar to high net worth individuals who have fixed rate, let's say mortgage debt, but they're earning now a higher interest rate on their cash, they're actually benefiting from it. So explains the divide in large and small caps. And I think recently, of course, with this expectation that the Fed is going to stay higher for longer, and we saw the yields rise in the 10-year and other maturities as well, this has hit small caps once again. But going forward, people ask, well, does this mean the next 10 years is going to be the same? Large caps going to outperform small caps? No, it depends on the direction, of course, of interest rates over the next 10 years, but that's just one factor. It also depends on what happens in terms of valuations. And as we've talked about, the S&P 500, if we look at multiples trading at a premium to, let's say, most small cap companies and certainly above small cap value companies. So just an interesting divide here, and will be interesting to see as we progress for the rest of the year. Can small cap companies kind of show their resiliency in terms of these higher interest rates, or is this really going to start hitting them? So we haven't heard very much so far about defaults, about an increasing default cycle. Credit spreads recently hit very low levels, and we were talking about that as another sign of complacency. So far, it doesn't seem to be the case that this is really turning into a default cycle. But the fear and the perception is that smaller companies are going to be hit much harder in terms of these rising interest rates. And if we look at earnings, I think that's been the case. We look at the increase in earnings for S&P 500 over the past 3 years, far outpaced the increase for the small cap stocks. So I want to talk about Netflix here. Netflix reported, by all accounts, pretty good numbers, beat expectations in terms of revenues, top line, certainly in terms of bottom line, net income. But the stock actually traded lower. And this is important because Netflix, obviously one of the leading sentiment stocks, and to see that type of reaction means a lot more was priced in than what we saw in terms of the expectations. So these companies are always beating expectations because the expectations are set very low, but the actual expectations, I like to say, are really only revealed when you see the reaction in the stock. So what happened in terms of revenues for Netflix? They had another record quarter of revenue growth, of revenues, 9.4 billion. Revenue growth moved up to 15%, plus 15% over the past year. That's the highest revenue growth we've seen since Q4 2021. Big driver of that has been fact that Netflix has been cracking down on the password sharing, and people have been actually saying, well, we like Netflix, we're going to keep it, we're actually going to pay it. So new subscriber growth driving that, and net income was up 79% year over year. So this is flowing through to the bottom line. Obviously, Netflix doing a good job in terms of cost management over the last year. And the paid subscriber numbers beat by 5 million. So I think they were expecting the number to come in around 265. It actually came in at 270 million. So another record high for Netflix in terms of subscribers. And that was up 16% over the last year. So you saw this period of stagnation here where Netflix had a very difficult time after the pandemic boost. But then since the password sharing crackdown, huge boost. And here's the interesting thing, though. Netflix has said in their quarterly report, we're no longer going to give you the subscriber numbers in the first quarter of 2025. We're going to focus instead on things like net income and operating margins. We're a mature company now. You shouldn't just look at subscriber growth. Now, how investors reacted to that, not very well. The stock declined 9% and so far, and a lot was obviously built into the stock before that, but interesting reaction there. Investors appearing not to be happy with that. And what I think they're saying, investors, is what is Netflix trying to hide? Are they trying to hide the fact that they think that growth is going to slow in terms of new subscribers over the next year once this bump up from the password sharing crackdown kind of wears off? So not a good reaction from investors, but a lot of people ask me when I tweeted about the numbers, well, why is it getting hit so hard? The simple answer is so much was riding on this report, not just being good, but being unbelievably good. You had the stock up well over 80% in the last year. So this type of reaction, I think, completely normal because you had such a huge run up heading into it. You have a stock that's not trading certainly at cheap valuations. I think it was trading at 40 or 50 times earnings before the report. And so certainly susceptible to any type of not, I wouldn't call it a miss, but any type of quarter that wasn't blowing things away. And given that run up, I wouldn't read very much into it at all. But we'll see what happens with the other tech companies as they report. Are they going to have a similar reaction? Many of them we know have run up significantly over the past year. Big one, of course, being Nvidia. So it'll be very interesting to see how they react to those earnings. Even if they have a beat, to see it actually go down means that investors are actually expecting much more. So when does valuation matter? Well, when valuation, by the time it matters, what I like to say is it's too late. You have to care about valuation when it doesn't matter. And I think the perfect example of this would be a company like Zoom. And Zoom, of course, being the biggest beneficiary of the pandemic, of the shutdowns, huge growth during 2020. Stock price obviously reflected it, just going crazy. going up significantly in 2020, actually peaked in 2020 though, and now is at a new all-time low, down 90% from that peak. So what happened here? Is it that Zoom is suddenly losing revenue? Is it that they're losing money? That's actually not the case at all. Zoom has continued to grow its revenues. It's not growing it as fast. The problem was the valuation that investors assigned it at the peak. It was such a crazy valuation. It was trading at 124 times sales back in October 2020. When you have a multiple that high, it's almost impossible to grow fast enough to grow into that multiple. But of course, that's what many people were arguing back then. Everyone's just going to be using Zoom. These enormous growth rates are going to continue. Of course, that didn't happen. If we fast forward to today, that multiple compression, so now trading at 4 times sales, that has led to this big decline in terms of price. So it wasn't that the fundamentals haven't improved. The revenues have continued to go up here since 2020. You can see the trajectory here. And actually, since it went public back in 2019, its revenues are up 10x. So 10x increase. It went from 100 million in revenues to over $1 billion in revenues, but yet the stock price is lower today than it was back then. How is that possible? It's possible because it was trading at 50 times sales even when it went public. So it was at an extreme valuation back then. It got even more extreme during COVID in 2020. And today, trading at what you might say is a reasonable valuation compared to other software companies. But investors obviously hating it today and loving it back in October 2020, which makes absolutely no sense. If you liked it back then as a company, you should like it much more today, down 90%. But that's not the way investors think. But just yet another example, by the time valuation matters, and it clearly matters today, it's too late. You have to care about valuations when it seems like they don't matter during these periods of mania. You have to say, this matters, this is too extreme, and the company is very unlikely to grow into these expectations. Speaking of that, Tesla being another example, and this week they announced job cuts, 10% worldwide. So they had about 140,000 employees at the end of 2023. So that would mean about 14,000 of those will be cut, which should really only bring it back to 2022 levels. And you can see here, enormous growth in the number of employees over the past few years for Tesla. So even with these job cuts, you're talking about significant growth over the last 5 years. But how did the market react? Not very well. The market didn't take it as, okay, this is going to help profitability. This is what they need to do. So this is a very short-term reaction, of course, and it's coinciding with the correction in the S&P 500. But still, stock trading lower here, now down 64% from its peak. Still on pace, I think, to be the longest drawdown in history. It will only take another month or so here to surpass the previous longest drawdown. But for now, I think the market continues to say Tesla, with its lower growth rate, with the fact that deliveries are now down year over year, revenue growth is flat to perhaps down. We'll see what happens in the next quarter with the price cuts across the board, hitting margins and hitting that net income number, that this 10% job cut may be a good thing in the long run, but not enough to turn the stock around here. And if we look at Tesla's price to sales ratio, at the Mania peak was trading at 30 times sales. Now you're at 5 times sales. And the big question everyone keeps asking me is that enough? And there's no way to answer that. All we know is historically, when Tesla was growing enormously, it traded as low as 1 time sales during this correction. So can it go lower? Of course it can go lower. It's all sentiment driven in the short run. Is it a better value today than it was back at the peak where it was substantially higher, 30 times sales? For sure, it's better. You should like Tesla better today than back then. But you have to believe ultimately that's going to turn around this growth story in terms of its revenue growth in order to support that current multiple. So if we look at Toyota and Tesla, and we talked about Toyota being the big winner with hybrids over the past year, they're showing 18% revenue growth over the past year, and Tesla's there at 3.5%, and maybe even at risk of actually going negative when we get the next quarterly update. And what we're seeing here in terms of valuation, well, there's still a big gap. Tesla trading at 5 times sales, Toyota trading at a little bit less than 1 time sales. So you can make the argument Tesla, not just a car company, Tesla's growth rate is going to turn around and get back into the 20, 30, 40% range. Okay, then you can justify this higher multiple. But as it stands today, this is a big divide if you don't have this growth. So we'll see what happens with Tesla. I wouldn't count them out by any means, but this is clearly a period where investors are caring very much more about the bottom line, caring about growth, and not assigning these unbelievably high multiples just based on a story. So yet another consequence of higher interest rates. We talked last week about those higher auto loan rates being the highest since 2001. Well, that has had a huge impact in demand. That's one of the reasons why Tesla decided to do those aggressive price cuts, so that they would sustain their growth numbers or try to keep up consumer demand, because they knew how unaffordable cars were at these higher interest rates. So people paying 8, 9, 10% to finance these cars, the math quickly becomes unaffordable, which is why they had these enormous price cuts. So ultimately, might prove to be a good strategy, but certainly a difficult time for Tesla in the short run. Housing slump continues. This is the Groundhog Day story that we keep talking about, but fortunately, it's not changing, and that's because mortgage rates moving back up now above 7% again, first time this year, highest since last December. We're at 7.1% on the 30-year, and at that rate, simply too high for most people to afford houses at their current prices. So that combination, not just the mortgage rate. So if the mortgage rate alone was this high, but prices had come down, let's say 20, 30%, I think you would see activity, but that's not what we've seen. We've seen mortgage rates go up this much over the past 3 years, going from less than 3% to above 7%. And yet you have home prices up significantly over this period of time, up 30, 40, sometimes even 50% in certain areas over the past few years. So that combination, rising mortgage rates, skyrocketing home prices, not very good for housing activity. We saw another month of declines year over year for existing home sales. So this is just the activity. The number of homes sold were 4% lower than a year ago. That was the 31st consecutive year-over-year decline, largest and longest period of year-over-year declines since 2007 to 2009. And why is activity going down? Well, this chart tells you everything you need to know. The average, looking at the home payment that you would need to afford the median home price for sale, hit another record high here, $2,775 per month. Note, this doesn't include taxes, insurance, maintenance, all these other costs that have skyrocketed as well. But if we're looking at just this payment alone, it's actually 88% higher than where it was 4 years ago. So just fundamentally unaffordable for most people based on your income. So if you don't have some huge down payment where mortgages don't really matter and they're not affecting you, well, this is going to be a problem. That's why we've seen a collapse in demand. And this was the unexpected part. We've also seen that collapse in supply continue because people who are locked into these low interest rates that they got in 2020 and 2021, or they refinanced during those years, they still are not moving. And many of them, because they're not able to move, they can't afford the house they're living in if they had to buy it today. So they certainly can't afford to trade up, let's say, if they need a bigger house. For now, they're staying in place. So what has been the impact in terms of retailers tied to the housing market? We talked about Home Depot, how its net income, biggest decline last quarter, 17% year over year, biggest decline we've seen since 2009. The crazy thing, though, what I pointed out after this quarterly report was the stock was rallying on this. It was actually going up in spite of these declines in net income. Well, now that has reversed with the market coming down here. Home Depot getting hit with the idea that the housing market's going to be in a more difficult period, I think, for longer here. So it was up close to 15% year to date in March, now down on the year. We saw a similar pullback, let's say, in some of the home builder stocks, still up on the year. But this idea that we're going to see a huge flurry of activity, people were hoping for that on the expectation that the Fed was going to cut rates and mortgage rates were going to come down, and that was going to start to stimulate things. I think that's still on hold for now. We're seeing a little bit higher inventories, let's say, than a year ago, but nothing to write home about just yet. So something to monitor closely. Obviously, people, their house is their biggest asset for most people, and the fact that there's very little activity in the housing market has rippling effects in terms of the economy, because they're not going out and buying appliances, they're not going out and buying all sorts of things that you would put when you move. And so that whole sector of the economy obviously reflecting a slowdown in growth. So let's end with something positive, as we always do, and that would be the fact last week we talked about a lot of the negative effects of higher for longer. If you're a net borrower, if you have credit card debt or auto loan debt, or you're looking to finance something, you're looking to buy a home and you need a new mortgage, all of that's the negative effect of higher for longer. The positive effect is if you're a net saver, you have cash on your balance sheet, you're going to be earning a higher interest rate on cash for longer now, with the Fed not going to likely cut rates in June, and perhaps maybe not in September, or maybe not at all this year, which some people are talking about, which nobody was talking about a few weeks ago. So here's the inertia, what I call inertia. The crazy thing is we have this yield available where you can get a high yield savings account, you can get a treasury bill ETF, you can get a money market fund, or you can buy treasury bills directly. All of these things are yielding above 5% for your cash. And yet, if we look at the national average rate on a savings account, it's still less than 0.5%. And this is just due to inertia. Banks are not going to just, many of the big banks especially, are not going to just give you this higher interest rate. They have to be forced to. And so we need to see depositors take their money out, put them in things like money market funds, which they've been doing, but still incredible to see the national average savings rate this low. So take a look right now. Make sure you're earning above 5% on your cash. If you're not, very easy to go out and find many different vehicles to do so. If you live in a state with high taxes, this is an important point I think not a lot of people focus on. Buying treasury bills directly can help you save that state tax. So all else equal, better if you live in a high tax state like New York or California to buy treasury bills directly, because you're not going to be paying state tax. If you have a regular FDIC insured savings account, that's going to be taxable at the state level. And if you look at 1 month, 2 month, 3 month, 4 month, 6 month, 1 year, all the treasury bills are still yielding above 5%. So you could just roll these over and get 5% for as long as the Fed keeps rates elevated. So the Fed can't control, well, they can try to control, but they don't really have ultimate control over the long end, looking at 10-year and 30-year yields. But on the short end, they have 100% control. So as long as the Fed keeps rates higher for longer, you're going to be able to get that 5% yield, but you might have to do a little bit of work to get it. So make sure you're getting that 5%. Don't let the banks earn that spread. Don't let JP Morgan Chase, which just has this huge increase in their net interest income over the last year, I think it was double digits, because they're still paying depositors very low rates and they're earning themselves higher rates on their own cash. So with that, we'll end it right there. I want everyone, if you're watching this on YouTube, just take a moment, hit that subscribe button for a lot more content just like this. Have an awesome weekend, and I'll see you next time on the Week in Charts.